Okay, so it's a little bit of a change in tack. I'd like to talk around the zinc market. I'll take you through our view of the supply-demand fundamentals, where we think prices are going, how far the story's got to run. I think the zinc story's been an interesting one in that it's been a story for quite a few years. And I think the key question is why haven't we seen this Chinese mine supply come in quickly and flood the market? And also what we think for longer term, how the zinc price may be sustained. So I'll go through zinc, and then I'll have a few slides where I'll compare and contrast the zinc sector for miners, and I'll look at some of the base metals as well. So in the supply side, I'll start with mine costs, cuts, and concentrates, really how we got to where we are in the zinc market, how the cuts of 15, 16 are affecting the market now, what we see for demand, summing it up in terms of a market balance and where we see prices. And then I'll talk a little bit on some of the cost drivers and how this may be different for the zinc mining sector and some of the other sectors. So just on the charts, what we've got here, we've got a cost curve. Basically, the gray area represents the 50th centile of a curve, blue is the 75th, and green is the 90th centile. So what I wanted to point out here is throughout the last 3 decades, once you've had prices breach the 50th centile, so highlighted in those red boxes, you tend to get a price response, a bull market within 18 to 24 months. There's no exception in terms of the recent one, so end of 2015, where the zinc market entered this bullish phase. We of course had Century and Lachine close down, and we had Glencore and a number of others idle a significant amount of mine supply. This has really turned the market, but it's had an important effect on the concentrate market, which we'll start talking through first. So on the left-hand cost curve here, it's just a position of some of the key idle capacity that remains off stream, how much we think is off stream, and just the relative cost position. But importantly, looking at what's happened in terms of the concentrate market as a consequence of mine supply cuts and idled capacity, you can see that on the concentrate balance. So this is on the right-hand side, and we see in 2012 through 2014, the market was in surplus. You were building concentrate stockpiles. As we exhausted mine supply at Century and Lachine and idled capacity, we've drawn down a significant amount of concentrate. In fact, we think this year, in the first half of 2017, we exhausted concentrate stockpiles, and this coincided with smelter outages in China. So this is fed through to the refined market. But importantly, a key indicator of this is looking at spot TCs in China. You've seen those have plummeted, and on the import spot TC basis, we're getting towards the zero mark, which is truly quite astounding. So the concentrate market is very tight. I think what's quite interesting is in the past, certainly high zinc prices have had a habit of curing high zinc prices, and that mine supply reacts quite quickly, quite nimbly, and you tend to flood the market. We haven't seen this yet, quite interesting. We haven't seen the Chinese mine supply response. So what we're looking at here is just the position of Chinese miners on the cost curve. They produce more than 40% of the zinc globally. And you see they spread eagled all over the curve. But what's quite interesting with this story, where we are right now, is the falling spot TCs. It's important for Chinese miners because they deal on a spot TC basis. Miners are paying spot treatment charges. And what you can see here, the blue bars in the bottom, is just the domestic value of concentrate for a miner and a smelter. And then the dark, thick red line is basically representing the marginal Chinese miner. And you can see in 2015, we were deep down the cost curve, and this was affecting Chinese miners as well. But certainly moving through this year, we've seen significant margin expansion for Chinese miners as well as global miners. And moving into the second half of this year, this is near record margins for Chinese miners. So the key question is, why haven't we seen Chinese mine supply come on very strongly and flood the market? And I think this is an interesting point going forward, and it certainly plays to the sustainability of how the zinc prices have rallied up till now. So this is an interesting chart, Chinese mine supply, and it's just highlighting the seasonality. Every first quarter, you get this winter-driven fall in supply. We don't expect there to be a material difference going into next year. And we think that's important because concentrate stocks have been exhausted globally, and it's questionable as to how much feed smelters have been able to secure running up into this winter season. So if we don't have a strong mine supply response, the outages that we saw in the first half of this year could continue, and the refined market could stay tight and tighten further. Moving through 2018, we do expect Chinese mine supply to rebound, certainly in terms of Q2, 3, and 4. How this plays into the whole outlook, and I'm just talking on a short-term outlook. I'm not looking at the sort of 10 or 15-year fundamentals of zinc, but certainly over the next 5 years, what we've got here is existing mine capability shown in white, and there's certainly a lot of closures on the horizon in the next 5 years. Rampura Agucha is a big one, which is going to be closing. Bisha's had a change mine plan in Eritrea. A number of the Canadian mines are approaching exhaustion. So we certainly see closures and contractions driving existing capability down. But this is hanging in the window. There is idle capacity sitting out there. Everybody's acutely aware of that. And as to the rate of this coming forward is quite important in the zinc market. But it's not just the idle capacity. There's been a strong reaction already. Rampura Agucha underground should largely offset the losses at the open pit. Gamsberg, Dugald River, Castellanos, these are supplying already, or very close to, and we've got some redevelopments. So we've already seen some returned idle capacity. So Neostar's brought back the Tennessee mines, or plans to bring them back. Myra Falls, Mount Garnet. So there's a significant number of redevelopments, new mines coming forward. And I haven't mentioned expansions. There are expansions going forward as well, from Antamina being one of the key ones, Neves Corvo, Vedanta have a number of expansions at their mines in India. So just outside of the world, outside China, we have a significant amount of new mine supply coming. It is reacting. It hasn't yet happened, but it is reacting. And inside China, I've just highlighted a couple of new mines and expansions here, which could bring nearly 1 million tons over the next 5 years. I think what's key here is, if I just go back there, we've got a large amount of mine supply on the horizon. So the question is this simply not going to flood the market and drop the zinc price? I think what's really important here is looking at refined zinc ultimately is driving the price of the metal. And what's happening on the smelting capacity side is particularly important. So what we've seen over the last few years, and certainly with spot TCs as low as they are, revenues for smelters and tight concentrate feed, it's a difficult justification to finance smelter investment in the zinc sector right now. Longer term, that slightly changes, but we don't expect smelting capacity growth outside of China. We do expect China to be the bulk, to take up the bulk of smelting capacity growth over the forecast. But I think importantly, we don't expect the rate of smelting capacity growth to match that of mine supply. So put that in a different, on the chart on the left-hand side, in gray are the bars where we see percentage change in mine supply growth. In dark blue is percentage change in smelting capacity growth. And what this means is we actually expect over the next few years a significant buildup of concentrate. So we drew it down through the first half of this year. We actually expect concentrate to build up significantly over the next few years, and the consequence of that will be interesting in changing the cycle for smelters. The chart on the right-hand side is looking at smelting capacity utilization rates. So this year, 2017, we tightened the concentrate market, we had the outages, and overall utilization was about 88%. Through next year, we think it's going to be very interesting in that the first half will be tight because of the slowdown in Chinese, the seasonality in Chinese mine supply. But from H2 next year and moving forward, we expect concentrate, the will to be a wash in concentrate, and we expect utilization rates to get back up to near records. And the consequence of this for smelters is that we expect treatment charges to start rising basically on a spot basis through next year, and on benchmark terms through the next couple of years after that. If we look at demand, roughly 14 million tons of zinc was consumed, or we expect will be consumed this year. China is the key market here. It's nearly 50% of the market. And going forward, we do expect a continual slowdown in Chinese consumption. And this is as the zinc-intensive construction sector continues to slow down. But saying that, you're still coming from a fairly large base. So in terms of absolute consumption growth, we expect between China and other Asia to contribute over 1 million tons of the next 1.3 million tons in incremental zinc demand growth. In Europe and North America, we don't expect they will get back to previous highs in consumption anytime soon. There's already talk of high zinc prices starting to constrain demand. I think this is interesting, certainly in terms of the zinc story going forward, whether end users can cope with the high zinc prices. And again, other Asia is our growth engine. In terms of our overall view, we do see zinc consumption growth slowing through next year and particularly through 2019. We think there will be a lot of demand destruction in 2019 with high zinc prices forcing users to switch to lower cost alternatives, aluminiums and plastics. If we sum this up into an overall refined market view, I've talked about the concentrates, I've talked about the smelting and the refined outlook. This year we expect a record deficit, around 750,000 tons in the zinc market. That's significant considering it's a 14 million ton market. And we do expect that deficit to continue through next year, but it's going to be a year of two halves in our view. The first half being tight, with the second half starting to unwind as you get more and more concentrate coming forward and smelter utilization picking up. If we look at the stock relationship chart, we've had falling inventories. We haven't yet got anywhere near as tight as the last boom in 06-07. We do think through the first half of next year we will get towards those critical stock levels. But what's quite interesting is looking at premia for metal, so metal availability, and certainly where we are now, it's just been news that Valleyfield strike is going to end, but you've seen a bit of a premia in USA based on that, but essentially premia have stayed quite low. So the tightening zinc market hasn't manifested itself in a general scramble for metal, so we haven't seen that yet. Longer term, over the next sort of 5 years, we expect the market to stay fairly tight, and that's largely down to smelting capacity. The smelting capacity or bottleneck there is going to be quite important as to the sustainability of zinc prices, whether the smelting capacity doesn't come on as fast as we think it won't. Okay, I'm going to turn a little bit just to where we see the market for miners in terms of margins and how the zinc sector may compare to other sectors. So firstly, on a processing and mining equipment index, we certainly think we've seen the end of cost deflation. So we're turning back into an inflationary environment. We think this will manifest itself quite differently across different countries. And these are basically set up for nickel, copper, lead, and zinc producers, the key countries producing those metals. And if we look at this and why we see that playing out differently, we expect foreign exchange. We expect a strengthening in the Chilean peso and China, which will drive up some inflation in terms of copper producers. In lead, we expect the strengthening of the Chinese renminbi is going to be key. China produces more than 50% of mined lead. Nickel, Russia, and Canada, resurgence in those currencies will lead to cost inflation. And zinc is actually fairly similar to lead. A lot of it's produced in China, and we expect that will lead to cost inflation on the zinc side. So summing that up together across those various sectors and looking at a currency index for the different metals and where we think cost inflation might be more acute, we certainly think for lead and zinc, you're going to see a bit more cost inflation than you are the other metals over the longer term. So turning to the zinc story and just looking at margins for zinc miners, so I've given you the background, I've given you our view on where we think prices may be going. The chart on the left-hand side talks to the steepness of a cost curve. So what's quite interesting there is if you look at through the 90s and mid-2000s, real zinc prices fell essentially. So you had falling zinc prices, you had high-cost producers coming off stream or at least marginalizing. So you had a flattening of the curve, and you can see that on the chart on the left-hand side. Came the zinc spike of 06, 07, you had a number of players enter the market, higher cost producers, you had a number of polymetallic deposits coming on stream, Penasquito and Antamina. A number of these assets are producing zinc as a byproduct rather than primary zinc producers. And you've seen a prolonged steepness of the zinc cost curve. I think what's quite interesting, though, is that steepness of the cost curve has coincided with significant margin expansion. So the chart on the right-hand side So looking at, in black, we've got zinc prices, and then we've got relative margins for the 90th centile, 75th, and 50th centile of zinc producers. And you've seen there's basically been a step up in the 2000s, and certainly where we are today, 2017, we think zinc miners are entering their highest period of potential sustainable margins in 3 decades. So it's an interesting time for a miner, but it's also interesting in that we expect treatment charges to rise quite significantly over the next few years, which will start to swing the revenue source back towards smelters. If you wanted to gain exposure to a zinc miner, this chart's just showing you basically the top 15 producers and mined zinc exposure, so direct mined zinc, not talking about trading or smelting. And on average, less than 20% of the revenues are coming from zinc. So it's a very diversified base of producers, and there's actually very little ways to get true exposure to the zinc price in terms of producers. And this also talks to why you've got a steepening of the cost curve. You've got a number of deposits, polymetallic deposits, rather than pure play zinc deposits. This is summing up our view for cash margins across the different sectors. And certainly we expect copper, lead, and zinc to have robust margins right now and certainly over the next few years. But where we do expect the fastest rate of growth is in the nickel sector. From being highly depressed at the moment, we do expect the relative margin expansion in the nickel sector to be quite interesting. And this is given the nickel sector has been under duress for quite some time now. So I'm going to sum that up. In terms of supply, we're still feeling the effects of the cuts of 15, 16 and the idle capacity. The conc market has been tightened. This has flowed through to refined. We're in record deficits this year. We expect next year to be a year of 2 halves, with the first half remaining tight, the second half starting to get more and more concentrate from new mines coming on board. And longer term, we expect a strong rebound of treatment charges. On the demand side, we expect demand to slow into 2018 and further through 2019. We think high prices will constrain demand, and by 2019 the market should be in balance. Further forward, we're looking at about 2% demand growth. In terms of price and view, we think the first half of next year will be the most interesting time for the zinc market, and certainly what happens in China is going to be key to what happens on the refined side. Over the medium term, the smelting bottleneck, I spoke of smelting capacity growth. To a large degree, if you don't have smelters developing quickly, this will help keep a lid on refined supply and support zinc prices. If you do have smelters coming on faster than we expect, then there's ample concentrate to flood the market. In terms of margins, we do think zinc miners are entering a period of robust margin, sustained margins, although we think they'll probably peak next year. And the fastest growth in terms of margin expansion we expect on the nickel side. Thank you very much. I don't know if we have any time for questions, but I'd be happy to take any questions.
Does anyone have any questions for Ryan on zinc?
Sorry, slightly off-piste because it's a question about nickel. But we had comments about battery nickel, so the bifurcation of the market between different types of nickel supply. Do you see that becoming material in the near term, or is that further out?
I think actually the interesting, well, firstly on the supply side, I think what's been interesting is you've actually seen discipline on the supply side from nickel. You've seen a lot of nickel sulfide operations close. You've actually had about 190,000 tons, I believe, so nearly 10% of the market came off, but it's obviously been replaced by the MPI story. On the demand side, in terms of batteries, I wouldn't be best placed to comment, but I do know our company has a view that over the long term, we think nickel will actually be quite a strong beneficiary in the battery. So the battery technology from the NMCs, we think there'll be a higher and higher intensity towards nickel. So that should be supportive, and that's certainly one of the growth engines in terms of nickel demand on our forecast.
You mentioned Chinese smelters, obviously. What do you think the appetite is for the Chinese government to allow new smelters to be built, given their environmental sort of policies at the moment?
I think it's interesting. Certainly over the winter, there's obviously the slowdown in concentrate supply from mining, but you've also got the imposed anti-pollution over the heating period. We don't think it's a particularly huge effect for zinc smelting. Going forward, you've certainly seen Zhuzhou being one of the biggest smelters in China. I think collectively it was 550,000 tons of capacity. And there's been a move to take a lot of that capacity outside of cities. So we expect Zhuzhou is actually going to fall over the next few years from about 550 down to 350. And so there's a reduction in capacity within areas that contribute to pollution. So that's certainly a trend.